So let's say you bought a house from a family friend and they cut you a really good deal. Mm-hmm. Let's say they said, no, we grew up with Johnny. We're going to take off $50,000 because we know him. Mm-hmm. And let's say it needed some updates and you did some updates to it. So now you've got a whole bunch of equity there because the house is worth way more and you got a really good deal on it. That's when you can tap in to get one of these home equity line of credits.
Okay.
We offer those at PyraMax Bank. But it's basically you have access to it whenever you need it.
Okay.
So when you look at your bank account on your app, you would see checking, savings, and HELOC. You would see literally a line item. You can transfer money instantly from the HELOC to your checking account.
Really?
Correct. So and people shouldn't use this for like fun money. Like,
yeah.
I like to think of it like an emergency net. It's there in case life happens and your HVAC, I don't know, your furnace goes out and now you need $8,000. Mm-hmm. You're putting that money back into the house. So the house is going to increase in value. So that would make sense, but I wouldn't recommend pulling out a HELOC if you just want to go on vacation.
Right.
Because just like a credit card, so if you don't use it, there's no monthly payment. If you pull money from it, you've got a monthly payment.
To pay back what you pulled?
Correct, yep.
Okay,
and
with interest?
Correct. Yeah. Interest rates, yeah. So right now we've got a special at 6.99% interest for the first.
For the HELOC?
Correct.
Okay.
So it's not free money.
Yeah.
So don't utilize it like it's free money. But like if someone wants to, let's say the same scenario, they've got a bunch of equity in the house, they open up a HELOC, and now they want to finish the basement. Mm-hmm. Finishing the basement might be $10,000, it might be $100,000, depending on how fancy you get. But you don't have that on hand.
Right.
You can tap into the equity on that HELOC to pay the contractors or go to Menards and do it yourself. Mm-hmm. The opportunity then, once the basement is done, is you can, if the interest rates are now more advantageous, you can also refinance to consolidate. You pay off that HELOC balance and put it into your first mortgage. Because all the costs associated on that HELOC, all the balance on it is because you put it into your house and made your house worth more.
Yeah.
So instead of doing interest-only payments on that HELOC and kind of carrying that debt and just having
6% too.
Correct. That's 6.99, 7%. Yeah. Instead of just carrying that debt, you can then consolidate it and have like a finish line on that.
Gotcha.
So a lot of people are like, well, my house is worth more now. Maybe they didn't put a lot of money down, so they might have what's called PMI, mortgage insurance.
Yep. Mm-hmm.
If they've done a bunch of renovations and now the house is worth more, the refinance can be advantageous for a few reasons. Reason A is get a better interest rate. Mm-hmm. Reason 2 is now you can consolidate your debt and put it on there.
Okay.
So you pay off the HELOC balance and now you just have one mortgage payment, but the house is worth a bunch more.
Gotcha.
So, and I walk my clients through that, but let's say you bought an interest rate 8 months ago and you've got a 8% interest rate because that's where rates were at a year ago. Uh-huh. And let's say in the next year to 18 months, rates come down to 5.5%. Mm-hmm. We can look at when you go to refinance, a lot of people might just refinance and put their loan back on a 30-year loan.
Okay.
So now you've reset your timetable.
Yeah.
So let's say you pay it down for 3 years or do renovations and then you refinance. If you put it on a 30-year, you're kind of doing yourself a disservice because now you put that back on a 30-year loan.
Right.
So if you can save 2% on your interest rate with a refinance just because of how the market is doing, I always say, hey, let's look at what a 20-year loan would cost you or a 15-year loan would cost you. Interest rates are dependent on risk, what I said earlier. Another factor to how much equity you have in the house and how good your credit score is how long is that term? If we're going to give someone a 30-year mortgage, that's a lot of opportunity for something to happen in their life where they can't make the payments. Mm-hmm. So the shorter the term on the mortgage, the better the interest rate.
Okay.
Because it's less risky.
Yeah.
We're not signing up to hold your hand for the next 30 years. We're signing up to hold your hand for the next 15.
Gotcha.
So it's not as risky, so you get a little bit of a better interest rate.
Okay.
So all those factors combined, if someone rates are now lower than what they currently have, if you can look at a refinance for them, maybe we can match their payment or have it be a little more than they're currently paying, but be on a 10-year shorter loan.
Right. Yeah, you're cutting the finish line a couple miles behind.
You're saving hundreds of thousands of dollars.
Yeah.
So whenever you're doing a mortgage loan, you get what's called an amortization schedule. Mm-hmm. And that breaks down how much of your payment is going towards principal and how much of your payment is going towards interest. With mortgages, the interest is very front heavy.
Okay.
You're not going to see a lot of traction on that loan for the first 5 years.
Really?
Yeah.
Okay.
So every time you refinance, you're resetting that timetable, paying a lot more interest for the first 5 years. Correct. So if we can shorten that term from a 30-year to a 20-year, I mean, man, it'll save you hundreds of thousands of dollars.
Yeah.
So with that amortization schedule, the thing with that is it's tricky. So if you were to make, and that just goes off of your minimum monthly payment, your principal and interest. That's what that calculation is off of.
Okay.
So let's say you round up, or you get a bonus and you put an extra $5,000 on your mortgage loan. That amortization schedule that you were following is now wrong. It's inaccurate because it's based off of the exact payment, minimum monthly payment. Mm-hmm. So you can go online and redo an amortization schedule or call me and let me know. Say, hey, Tony, if I inherited $40,000, if I put that on my loan, how much money is that going to save me?
Yeah.
Does it make sense to refinance, or can we just modify your mortgage and make it a lower monthly payment because you did a huge lump sum on it?
Okay.
What options do we have to save you the most amount of interest?
Yeah.
So.
Gotcha. And for those, I'm trying to think of if you did like a 15-year instead of a 30, it would be less risky for you guys because you're borrowing out money for a less term, but it's also bigger payments for somebody to pay.
Correct.
So do you have to decide, like, if their credit's looking good, if their income looking good, that they could go to a 15-year thing instead of a 30-year, or could anybody do a 15-year?
Anybody can do it. It just depends on your monthly budget and if you're comfortable with it.
Really?
One factor that we look at is called your debt to income ratio.
Okay.
Your DTI. We want to keep that below 45%, hopefully. So 45% debt ratio is 45% of your fixed expenses, including the proposed mortgage payment, and compared to your gross income.
Okay.
Now, what a lot of people don't, they come to me and they say, Tony, what's my max budget? We're looking at someone's gross income when I'm giving them a max budget, not their net. So if they're doing 10% to their retirement accounts, if they've got health insurance before they get their tax bill, there's all these deductions. I'm going off of that big shiny number up top.
Yeah.
Not what you actually see in your bank account. So it can put a lot of people in a tight position if they do max out their budget, because I can get you approved for probably a lot more than you're willing to pay monthly.
Yeah.
And having, just that thorough conversation of, okay, right now we don't have kids or kids that are in daycare. We don't have car payments. What happens when we do?
Yeah.
We can afford this house payment now, but in a year from now, we've got $1,000 or $2,000 a month in daycare costs.
Right.
We've got a $700 car payment. Now can we afford life?
Yeah.
And groceries and insurance and,
it adds up. Yeah.
It adds up. So I have that thorough conversation with all my clients. It's like, hey, okay, here's what I can probably get you approved for. Are you comfortable with that payment? Does that payment give you heartburn? Let's think in 3 years from now, can you still swing that payment if you've got kids in daycare?
Right.
So just having that conversation and really opening up people's eyes, because they want the most, the best house they can afford.
Yeah.
But it's like, hey, do you really want that payment?
Yeah. Can you afford it in the next couple of years? Right.
Correct. Yeah. So otherwise, then you get people that have to downsize, or they can't afford to get a new car because they've got a big mortgage payment.
Right.
So it's like, let's take a holistic approach and look at the big picture here. Is this something that you're comfortable with now? And do you think you'll be comfortable with it in 3 years? So.
Right. So going back to the HELOC, can you access that right when you buy the house? Or say, would you have to, so we'll give this as an example, like you bought the house for like $200,000 and then you did some fixing up and now you got it appraised at $400K. So you'd have that $200K that you could pull out on credit.
Yep. So we'd like to keep it, the HELOC at 80% loan to value. That's where you get the most advantageous interest rate.
Okay.
HELOC. So 80% on 400 would be, what is that, 320?